Okay, so we're going to dig a little bit more into the weeds for non-financial and non-GAAP measures. So a company like Spark Tech would want to consider non-financial and non-GAAP measures because they provide a broader, more comprehensive picture of the company's health and performance. Financial and GAAP metrics are very important, but they don't capture everything. Okay, so when we talk about a company's health and performance, it's not just about how much profit it's making right now. It's also about the company's relationships with its customers. Customers and its employees, how efficiently it's operating, its capacity for growth and innovation, and much more. So non-financial and non-GAAP measures help capture these aspects. So let's fire it up by talking about customer retention rate. So a high customer retention rate indicates that a company is successful at keeping its customers over time. All right, we're keeping our customers happy. This could be due to a high customer satisfaction, product or service loyalty, or successful customer relationship management. A low rate may signal customer dissatisfaction or strong competition, posing a risk to future revenue and profitability. So if Spark Tech has a customer retention rate of 85%, which means that it is successful at keeping 85 out of 100 customers from one period to the next, this would indicate a high retention rate, suggesting that Spark Tech is delivering a product or service that meets its customers' needs and expectations, as well as contributing to stable and potentially growing revenue streams. Next up, we have employee turnover rate. So a high employee turnover rate can indicate that there is dissatisfaction among employees, potentially due to low morale, inadequate compensation, or poor working conditions. So this could pose a risk as replacing employees is often costly, and frequent turnover can disrupt operations and negatively affect productivity. So let's assume that Spark Tech's employee turnover rate last year was 15%. This implies that it has lost 15 out of every 100 employees. And this is a relatively high turnover, and that might indicate underlying issues in Spark Tech's work environment or compensation structure, potentially increasing costs related to hiring and training and potentially disrupting operations. So next up, we have labor productivity rate. What does this mean? This measure indicates the output that a company gets for each unit of labor. Higher labor productivity suggests more efficient operations, which can lead to increased profitability, whereas low labor productivity can indicate operational inefficiencies and can be a risk factor for competitiveness and profitability. Okay, so circling back to Spark Tech, let's say that they produce $80,000 in revenue per employee, which if they're paying them $40,000, this could be a relatively high labor productivity rate, which might indicate operational efficiency. However, if its competitors have higher rates, then Spark Tech may need to look for ways to increase its productivity or risk losing market share. Ticket response time, all right? Have you ever submitted a ticket to IT or customer service? Ask yourself, what would indicate that this is better customer service? Well, how about the faster they get back to me? So in a customer service context, a shorter ticket response time usually indicates effective customer service operations and can contribute to customer satisfaction. Longer response time may signal operational inefficiencies and can lead to customer dissatisfaction, posing a potential risk to customer retention and brand reputation. Okay, so if Spark Tech has an average ticket response time of 2 hours, and that's relatively quick in comparison to its industry competitors, then this quick response time suggests effective customer service operations, which could contribute to customer satisfaction and retention. Okay, so those were non-financial measures. Now let's talk about non-GAAP measures. So thinking about EBITDA, it's all about EBITDA. What does this stand for? Earnings before interest, taxes, depreciation, and amortization. All right, so EBITDA provides a view of a company's operational profitability by removing the effects of financing costs, tax structures, and non-cash expenses. Okay, so it's all about EBITDA. A high EBITDA can indicate strong operational performance. However, it doesn't consider the cost of capital investments, so relying on EBITDA alone could overlook potential risks from high debt levels or substantial depreciation and amortization expenses. So Spark Tech reported EBITDA of $10 million last year, and this is big compared to the industry. So this substantial EBITDA implies strong operational profitability, but it does not consider Spark Tech's debt service obligations or capital expenses. Hence, it must be reviewed in conjunction with other metrics like net income and free cash flow for a more holistic view. Okay, so we might say, hey, this company's really profitable, they're killing it. But maybe that's because they borrowed all this money to pour into its operation. Okay, so after we take a look at all that debt, that might spook us a little bit. Okay, and then we got free cash flow. It's all about free cash, baby. So this measure shows the cash a company generates after accounting for capital expenditures. It indicates the company's ability to pursue opportunities that enhance shareholder value, such as paying dividends, buying back stock, or investing in growth. Low or negative free cash flow could signal financial strain, while consistently positive free cash flow typically indicates strong financial health. So if Spark Tech has free cash flow of $5 million, this might indicate that after accounting for capital expenditures, it still has $5 million available for activities like repurchasing shares, paying dividends, or investing in future growth. Right, we got this boatload of cash. What are we going to do with it? Are we going to pay dividends? Are we going to pay ourselves? Are we going to invest back into the company? So this positive free cash flow suggests good financial health. What about core earnings? Core earnings aim to reflect the earnings from a company's primary business operations. It provides a clearer picture of a company's earning power, specifically from its primary operations. Variations in core earnings might indicate underlying issues or successes within the company's main operations. So if Spark Tech reported core earnings of $8 million, this would represent that the earnings come from its main operations. So consistent growth in core earnings is good news. It suggests that Spark Tech is thriving in its primary business. And then finally, we have adjusted net income for non-recurring expenses. What does this mean? This measure provides a view of a company's profitability that excludes one-time or unusual expenses. So while it can provide a clearer picture of ongoing profitability, the exclusion of non-recurring expenses can also distort the company's overall financial condition. So for instance, if a company has frequent non-recurring expenses, it may be facing deeper operational or financial issues that are being dismissed as one-off events. So let's say that Spark Tech reported net income last year of $6 million, but after adjusting for $1 million in non-recurring expenses, its adjusted net income was $7 million. So while these adjustments provide a clearer picture of Spark Tech's ongoing profitability, a pattern of frequent non-recurring expenses could signal potential underlying operational or financial challenges. Okay, so at the end of the day, no single measure can provide a complete picture of a company's performance or risk profile. But they are all uniquely important, especially for financial reporting purposes as well as managerial accounting purposes.